Hi everyone, and welcome to week 8. In this video, we're going to cover concepts surrounding absorption and variable costing. Specifically, we're going to talk about the effects of variable and absorption costing on both inventory and operating income. We're going to also create a pivot table, and we're going to analyze the data inside of that pivot table. So let's get started. Our problem set for this lesson starts with Big Sky Creation Company. So during their first month of operation, which ended in May, Big Sky Creations Company produced 56,000 designer cowboy boots. Of the 56,000, we sold 52,000. That means that we had 4,000 units that were stored in inventory at the end of the month. So the operating data for May is listed below. You see that I have the units produced is 56,000 and the units sold are 52. The company provided all of this information so that we could run some income statements for them. So we've got our sales, manufacturing cost, and selling costs. Keep in mind that we have both variable costs and fixed costs listed in all of this data. During the month of June, Big Sky Creations produced 48,000 designer cowboy boots and sold 52. In this scenario, in this month of June, they actually produced less than they sold, which is okay because remember at the end of May, we had 4,000 designer cowboy boots that were left in inventory. So the data for June is summarized below. We have 48,000 units that we produced, 52,000 units that we sold, and then again we have our sales, our manufacturing costs, and our selling costs. So before we jump into the solution set, let's talk just a little bit about the differences between absorption and variable costing concepts. So the two biggest differences between these two costing concepts is that absorption costing is required under generally accepted accounting practices, and it's required for the financial statements. Variable costing, of course, is not going to be GAAP compliant, but it's used for internal decision making, for performance management, and also for pricing decisions. Absorption costing incorporates both your variable costs and your fixed cost. And those costs are incorporated in the cost of goods sold as well as inventory. Variable costing, though, only incorporates the variable pieces of your cost of goods sold and your inventory. So the costing methodology really impacts the operating income as well as your inventory costs. Absorption costing includes, like we said, even the fixed manufacturing costs. So we consider this fixed manufacturing cost to be capitalized or stored as inventory when the production is greater than sales. In this first scenario, or in the first month of May, that's the situation that we have. We have actually produced more than we have sold. So now let's go on to the solution set. And because there's so much data here, I'm actually going to hide some information so that we can focus on just May. Okay, so we were told to prepare an income statement for May, and we want to prepare that income statement both as absorption costing, which is the first side, and in variable costing income statement. So the income statement is set up the same. We start with sales, we move to cost of goods sold, we have our gross profit, selling and administrative expenses, and operating income. Now let's talk about where we get our data from. So the 858 just comes from the information that was provided to us. Our cost of goods manufactured, remember this is absorption costing, so we're actually going to pick up all of these costs, and we can see that over there. It's the 655. But let's talk about our inventory. So we produced more in May than we sold. So we have to subtract out the inventory that's still sitting as an asset in our accounts. So for this one, we can see that I've picked up the cost of goods manufactured, I divided it by how many we produced, and then I multiplied it by how many units that we had left in our inventory. But let's look at those interim calculations. So first of all, let's talk about the cost of goods manufactured per unit. So I'm actually going to pick up my cost of goods manufactured, and I'm going to divide it by the units that I produced. This tells me that each unit was $11.70. But I also need to know how much did I leave in inventory. And while we can really quickly see that it's 4,000, I'm just going to do the calculation so that we can see that we have 4,000 units that cost $11.70. I'm just going to multiply these two together. And that gives me 46,800. And we can see that down here, 46,800. I made this a negative just because I want to subtract out the inventory. So now the total cost of goods sold are these two, and that is $608,000. My gross profit is just the difference between my sales, which is my revenue, and my cost of goods sold. My selling and administrative expenses, again, that was given to us. And then my operating income is $192, and it's just taking my gross profit and subtracting out my selling and administrative expenses. Okay, that's great. So based on absorption costing, my operating income at the end of the month is $192,400. But what if I were to use variable costing to construct my income statement? And so that's what I've done over here. Again, we still start out with sales, but then our categories are just a tiny bit different. We have our variable cost of goods sold, manufacturing margin, variable selling and administrative expenses, and then we have the contribution margin. After the contribution margin, we have our fixed costs. So we have our fixed manufacturing costs and our fixed selling costs and our total costs. We're going to get an operating income, and you can already see that our operating income is lower over here. So let's talk about why. Starting at sales, we know where we got that data from. But what about our variable cost of goods sold? With the variable cost of goods sold, I only want to pick up the variable pieces, which are my direct materials, my direct labor, and my variable manufacturing costs. So my cost of goods sold starts with the variable cost of goods manufactured. I now want to pull out my inventory for May. So my inventory, you can even tell that my inventory is different than my absorption costing. And why is that? Well, I have my variable cost of goods manufactured. I divide it by how many units I produced, and then I multiply it by my 4,000. That tells me that my inventory that are left over at the end of May is 42,800. Now the difference here is the fact that I didn't pick up the fixed manufacturing costs. Fixed manufacturing costs are here, but they're not here. So my total variable cost of goods sold is $556. My manufacturing margin is just the difference between my revenue and my total variable cost of goods sold. My variable selling expenses come from above, and so my contribution margin is $270,400. My fixed costs, I picked up the fixed manufacturing costs and the fixed selling cost. And so my total fixed costs are $82. My operating income is $188,400. So why is my operating income in May so much lower than my operating income under absorption costing? And it's because we actually expensed the fixed manufacturing costs versus storing some of that fixed manufacturing costs in inventory at the end of the month. All right, let's go on to the June statement and see how things are different when the scenario is flipped. So I'm going to open this up because we're going to be using the June data. I'm going to hide this for a moment. We'll come back to it. Okay, so now we are looking at June data. And as a reminder, we produced 48,000 units, and we sold 52,000 units. So again, we're just picking up that data. We have our sales. We have the inventory that actually came from last month, right? We have to add in inventory that we produced in May because we're going to end up selling it this month. We also have our cost of goods sold, and we're going to add these two. So my total cost of goods sold is $616. My gross profit, again, just the difference between those two, and my selling and administrative expenses don't change. My operating income is much lower than it was for the month of May. And again, it's because we produced fewer items than we sold. Now coming over to our variable costs. Again, there's my sales. I added in the inventory that came from May. My variable cost of goods sold, again, I'm picking up these three items. And so we can already see that things are much different. You can see the differences in the cost of goods manufactured. Again, we have our manufacturing margin, our variable selling and administrative costs. We have our fixed costs down here. And so our operating income is $188. And again, why is that? It's because we actually stored some of those fixed costs here, fixed costs that should have been, or not should have been, but fixed costs that were incurred in May, were stored in inventory for your absorption costing, but they were not stored in inventory for the variable costing. So I'm going to take a moment and we're going to look at May and June together. And the one thing I wanted to point out is actually at the bottom. Here we go. The effects on our operating income. When we are constructing an income statement using absorption costing, when we sell more than we produce, so when units sold exceeds the units produced, then we should see that our operating income decreases. If we produce more units than we sell, so the units produced exceeds the units sold, we should see our operating income increase. And we can see that here. So we had a higher operating income at the end of May, and we had a lower operating income at the end of June, even though that we're selling the same number of units. For variable costing, if the units produced exceeds the units sold, we should actually see our operating income decrease. And then if our units sold exceeds the units produced, we should see our operating income increase. But we don't see that in this scenario, do we? I see 188,400, and over here in May I see 188,400. So why wouldn't this follow this graph that talks about the effects on operating income? It's actually because, if you notice, our total variable costs are the same. And it's because the 4,000 units that we did not sell in May, we ended up selling in June. So while while this feels like it does not follow the rule, it does, mainly because the 4,000 units that we did not sell in May were sold in June. All right, so we've talked about the effects of absorption costing and variable costing on our operating income and our inventory. Now let's talk about pivot tables. So all of this data that people have put together to allow us to analyze data and find out, profitability, let me go back to that last spreadsheet, talking about the cost of goods sold, selling and administrative expenses. It's never neat. The data that you receive as an accountant is never really neat. So we have to learn how to gather and collect as much data as possible and turn it into not just data, but information. And that information needs to be packaged in a way that we can actually make great management decisions. The spreadsheet in front of you has, hundreds of lines of data. How many lines? Oh, wow. We have 501 lines of data. Actually, it's 500 lines of data. We could go through this line by line and sort it out by segments. We have a sports segment, an arts segment, a charity segment. We could do it line by line, or we could get the spreadsheet to do the work for us. So in the last piece of this video, we're going to talk about pivot tables, and that's part of making the workbook or the spreadsheet work for you, right? So I want to block off this data. I can either click and drag and block off all of this data, and we've already talked about the fact that it's got 500 lines, or I can just click on this first cell, and if you're on an HP, it's Command A, and if you're on a Mac, it is, I got that backwards. If you're on a Mac, it's Command A, and if you're on an HP, it's Control A. So when you do that, it captures all of the information very quickly. It blocks it off for you. So now that we've got it blocked off, I want to create a table. So I'm going to the Insert ribbon, and I'm going to click on Table. This asks me, where's the data for your table? And we've already blocked it off. My table does have headers, so I've got that checkbox, and I'm just going to say OK. And so very quickly it puts it in a table for me. Now I can go through and I can sort these piece by piece if I wanted to, but again, I want the spreadsheet to do all the work for me, or at least as much of the work as possible. So I'm inside of this table. Now I want to insert a pivot table, which is this first option right here. So I'm just going to click on that, and it asks me what is my table or range, and I've already created my table, so it's table 1. That's good. Now I also want it to create a new worksheet for me. I want to work on a different worksheet. So I'm going to say OK. And let me drag this up so that you can see the data that we were on was on this tab. It's the data tab. Now I have another sheet, and that's over here. And I'm just going to call this pivot. All right. Now let's make this a little bit bigger. It's tiny. There we go. So I want to add information in my pivot table. So I'm over here in my pivot table fields. I'm going to grab segment, and I'm going to drag it into my rows. You can see that my art, charity, food, music, and sports are now populated in my pivot table. Now, what do I want my pivot table to tell me? Well, let's see. First of all, I want to know how many transactions occurred in each one of the different segments. So I'm now going to grab my segment, and I'm going to put it in values. And this tells me that I had 102 transactions for art, I had 87 for charity, and so on and so forth. I can actually change this if I wanted to. I'm going to right click and I'm going to choose the value field settings. And I'm just going to change the title for this first one. All right, so that's transactions, and I'm going to click OK, which you can't see, but it's down here at the bottom. All right, so now I have transactions, and I've changed it up here. What else do I want to know? I probably want to know what my sales were. So I'm going to drag sales down below transactions in the values quadrant, and we can see that it summed up all of my sales. So again, I can go over to value field settings, and maybe I want to call this revenue. So it changed my revenue, but my data is not in, maybe I want it to have the dollar sign. So again, I'm going to right click on value field settings, and I'm going to choose the type of number I want. I could go with currency. That actually looks pretty good. I'm going to choose this one. And the OK button is at the bottom. All right, so now I have my revenue. Maybe I also want to know, actually, let me click over onto my data tab. So in my data tab, we sectioned everything out by segment, sales, and how much tax we were paying. So maybe I want to know my average tax. So I put my tax over here, but this didn't tell me my average. So let me see what I can change. So the first thing I want to do is I'm going to change the number again. I'm going to go back to currency. But then I want my average. I want to know what my average tax was for each transaction. And I'm going to change this to taxes. All right, that's my average taxes. Maybe I also want to see which segment is most profitable per transaction. So right now we can see that the sports is the most profitable overall, but I also had 113 transactions. Maybe there is another segment that's more profitable. So let's go ahead and add. I'm going to go back to my sales. I'm going to drag it down. And I'm going to change this so that it is my average sales. Oop, let me change my number first to currency. Then I'm going to change to average. And I'm just going to leave the title. All right. So this shows me that sports is still the most profitable per transaction. Each transaction brings in an average of $102 worth of revenue. That's great. My least profitable segment is the art. My average sales are only $21.57. So for each transaction, I'm only bringing in $21.57. Whereas if I stuck with the sports, I could actually make just a tiny bit more money, actually quite considerably, a considerable amount more with sports. We can also see that music is relatively profitable, and then we have the food and charity. So these are ways that you can take a lot of data, like we have here, 500 lines worth of data, and very quickly put it into a report that helps you make decisions. So let's just say you had all of this data to start out with right here, and someone said, you know, we've had a lot of people who have quit. We need to focus the few people that we have left working for us. We need to focus their attention on the areas where we're most profitable. You could run a very quick pivot table and decide, of the few people that we have left, I feel like we need to focus on sports, music. Those would be my first two. And then if you had enough people, then you would prioritize them in the food and the charity, and then art would probably be the last segment that you would want to divert any resources to. So, we have finished the video for this week. We've talked about absorption costing, variable costing, how to create a pivot table, and how to take large data sets and very quickly put them into reports and spreadsheets that make it easy to make decision or for leadership to make decisions. All right, thanks so much for joining me, and I'll see you in the next video.